Equity markets have been rallying. Like I mentioned in the headline as well, the Sensex and the Nifty have managed to rally for the 10th straight day. It's definitely been a joyride, a Santa rally, if you could call it that, for the Indian equity markets. And what's interesting is that we have seen this consistent rally of sorts, ever since the crisis actually broke out. So since April, it's almost been a one-way journey for the equity markets with a few dips here and there. So those individuals who, patiently held on to their holdings have definitely been rewarded by the equity markets. But now, of course, with the markets at record high levels, we will be understanding, especially for those individuals who have their goals for which they were investing coming in close by, what should be a proper and efficient exit strategy. Because at the end of the day, you're investing so you can reap the benefits of wealth creation that the equity markets do offer. And that's really what it has done, especially if you look at the benchmarks, the large cap mutual funds. So let's introduce on the show Sunil Jhaveri, mentor, author and an advisor. He's also the founder of MrBond.in, a B2B platform for mutual fund distributors. Sunil, thank you so much for joining us today on ET Now. So let's start off first with the fact that, yes, the markets have rallied, but the question is, who should consider booking profits right now?
No, first of all, Mubina, let me just explain to you and put things in perspective, because people are just getting carried away with the current rally. What people do not realize is this is just they are recouping their losses of March. They have not got into hugely positive territory at all. We had given an exit call in July 2017 when we went into a conservative asset class. By March, actually, if you were invested in, say, large cap fund, the value of 1 crore in March was 85 lakhs. In a mid cap, it was almost 60 lakhs. In a small cap, it was 45 lakhs. So from there on, you are just recouping all the losses. So even currently, if you see from 1st of July to now, large cap Nifty 50 has delivered 11.3%. And all of us know that that is also because of the polarized 10 or 15 stocks which have delivered returns. Mid caps have barely broken even and gone into positive territory, delivering about 3.5 or 4% returns. And small cap, by the way, is still in the negative to the tune of almost 1.5%. So please put things in perspective over the last 3 years, and you will realize that this raging bull rally is nothing but recouping of losses for many of those buy and hold investors.
Okay, that's an interesting take, actually. Sunil still believes that whatever we've been seeing till now is actually just sort of the markets trying to recoup the losses that we've seen, since March. In fact, if you look at it from a more larger perspective, I think there's still some more room, or at least Sunil believes that there's still some more room for a rally. So Sunil, at this point of time, especially for long-term, investors, most of our viewers invest in equity mutual funds. They do so via SIPs or lump sums. Most of the time they're investing, with a goal that's more long-term in mind. Do you think they should absolutely stay put right now?
No, I'm not saying that at all. I'm saying that, people are just getting carried away with the current rally. Markets are overstretched in terms of valuations, be it on price to earning, price to book, or market cap to GDP also at historical highs. We've never seen this before and on a sustainable basis for the last 4 or 5 months. Yes, you should have an exit strategy. When the markets are expensive, all you need to do is move from expensive or aggressive asset class like equity and get into something like dynamic asset allocation funds, which would be, say, 30 or 40% in equity at the current juncture, because markets are expensive. What I was trying to tell you when I said that, markets are only recouping losses, we are back to that March, scenario again between Jan to March. Something similar is happening now, where the second lockdowns are happening. The global markets are extremely expensive. Also, US markets, especially Indian markets, are expensive. And everybody knows that this is purely a liquidity-driven market. There are no fundamental legs to stand on. Any change in the interest rate scenario, any change in the dollar going up, any change in the fiscal stimulus being stopped, or any of these news or second or a third lockdown will definitely have a major possibility of correction, both in the global context as well as in the Indian context. What people need to realize is, do not look at the numbers, pure numbers only. 21,000 Sensex in January 2008 was more expensive than 42,000 Sensex of January 2020. What I'm saying is that you should see the underlying valuations, and the underlying valuations currently are definitely on the higher side. Exit strategy means that when the markets are expensive, you need to take the money out of the market, but do not get into a debt kind of a product where it will underperform and you may or may not be able to come back into equity, because this liquidity driven rally can be irrational and can go on for maybe a few more years also, or maybe the entire year of 2021 also. I'm not commenting on when the markets will correct. But having said that, finally, it is your money. You need to protect it. What if your goals were in, say, March 2020 and you needed the money? So should you exit just based on the goals? Answer is clearly no. You should have an exit strategy based on where the market valuations are. So, unfortunately, we've been told that you should exit closer to your goals coming nearer, and that's when you try to exit out of your equity portfolio or your aggressive portfolios. According to me, that's a wrong way of doing it. You should exit as and when the markets become expensive, get into a conservative asset class. And when the markets become cheap, which happened in the month of March, you can always re-enter equities at much cheaper valuations. In the month of March, if you are sitting on in equity and you see your portfolios bleeding, will you have the guts or the money to reinvest, which was the ideal time for anybody to invest? Answer is clearly no. Most of the investors actually exited in March and have not participated in this rally at all.
Very interesting approach, actually, Sunil. And yes, you're absolutely right and bang on when you say that many people, purely from a personal finance perspective, I as a retail investor, let's say I have been investing for the last, 10 odd years for my kids' education, which is perhaps due in the next 2 years. What the normal advice is, the most frequently heard advice is that, okay, now I should slowly start trimming from equities and move into a debt fund, which is less volatile, less risky. But what you're advising is exit not based on goals, but when equities as an asset class starts getting expensive. So it means, Sunil, that you would recommend, investors to sort of keep track of valuations of sorts of the markets. Just to put it into perspective, Sunil, let's just take the example that I gave. Let's say if I have my child's education and he or she is going to go study abroad, maybe in July 22, because 21 is too close, but let's say July 22, and I have my certain portfolio allocation. For such an individual, what would be an exit strategy to ensure that this corpus that are put in equities is not now subject to too much fluctuation?
First of all, whenever as it is, if you're already sitting on profits and your goals are coming nearer, naturally you need to exit out of equities and get into a conservative asset class, because you can never time the markets either at the top or at the bottom. So having said that, when your goals are nearer, so what I try to tell investors, especially at the age of 55 and above, and if you're going to be retiring, say at the age of 60, and you want a sizable corpus and not a negative corpus when you start your retirement, is start getting into a conservative asset class. Then there is no question of valuation. If your goals are 1 year, 2 years away, there is no question of valuation or entries and exits and all that kind of complicated issues. Best is get into a conservative asset class or get into debt if the goal is maybe 6 months or 1 year down the line. So at that point in time, if you're already in profits, this is the current valuations, and your goals are 6 months or 1 year away or even 1.5 years away, definitely get out of it and sit on cash. Let that earn you 3 to 5% return. That should not bother you at all, because you're not trying to maximize your returns here. You should be looking at optimum risk-adjusted returns, and that can only happen when you think logically, apply some common sense, and get out of aggressive asset class. Then after that, you do not have a fear of missing out, because a lot of people actually have a fear of missing out. They exit. And then if the markets are going up, like we gave an exit call in July 2020, we are in a dynamic asset allocation fund, but we participated from March to July. So and on top of that, we had already safeguarded the entire March 2020 crash also. So if your 1 crore is, say, less than 1 crore in, say, small cap currently, it's approximately 99 lakhs. In our strategy, that 1 crore would have been 1.5 crore rupees. So the entries at the right time, exits at the right time are extremely important. People, we've been told buy and hold, sip karo, bhool jao, etc. that really does not work because, if you see the data, if you invest today, your returns, future returns are dependent on the time of your, when did you invest? So if you have invested in the red zone, then you will have to maybe hold it for 5 years, 10 years or 15 years to deliver returns. From Jan 2008 to Jan 2020, Nifty had only delivered 3.5% return. Why? Because we had invested at the most expensive valuation in January in 2008. So entries are also as important as the exit strategies. So according to me, a combination of both will deliver returns and wealth creation possibility for the investors.
I think, you've explained that very well. I actually had a follow-up question, which, you've as well sort of answered. But you know what, I'm going to ask it nevertheless for the benefit of all our investors. In the beginning, you mentioned that, let's say, if you're sitting on profits, it's great, go and exit. And yeah, after that, even if, let's say, you want just 2 to 3%, it should not really bother you because your aim then is not wealth creation, but it is to preserve the cash for your stated goal. What do you do then for those individuals whose mutual funds are not performing as well? Because, like you mentioned, there are some categories of within the markets that are not doing that well. You spoke about mid caps, small caps. So what does one do in such a situation then?
No, so basically, you cannot just isolate certain periods of time and say that my portfolio is not doing well, so I should exit or I should switch to something else. That's not the right way of doing it. Let's assume that there are schemes which are only following growth and momentum stories. So even at expensive valuations, they will continue to hold on to those expensive stocks also. And there are some strategies which are value-based strategies, which looks at cheaper valuation. But right now, because of the liquidity driving the markets, that growth and momentum is outperforming the value strategy. So if you are in a value strategy which is underperforming currently, as and when the markets correct or going forward, when the markets rebound again, the value strategy may start outperforming versus the growth and the momentum. So, you have to, first of all, figure out which portfolio are you in. You cannot generalize and say, because something is not working for me, I should switch into something else. There will be business cycles. There will be markets ups and downs. There will be portfolios which will underperform and portfolios which will outperform. All that will be dependent on what kind of strategy and what kind of valuations you've invested in, whether you are in a growth strategy, value strategy, etc. You need to ride many cycles, business cycles and market cycles for you to actually come out on top.
Okay, very interesting, Sunil, and thank you so much really for helping our viewers out. And I'm sure many of them must be thinking that, okay, my NAV is not as high as some other NAV would have been. I started investing at this point of time, but I think you've explained it in a very holistic manner, and I hope our viewers as well take note of everything that you have mentioned over here. Okay, well, moving on, as we always do on The Money Show, we'll take on board some questions and queries that we have received from our viewers. Remember, folks, if you'd like to connect with us, you can email us on themoneyshow@etnow.tv. Any questions, queries regarding your personal finance, your mutual fund portfolio that you may be having, write into us and we'll get it answered. So first up, we have Aditya Bodhi, who writes in saying, I want to invest via an SIP for my son's education, which is 18 years from now. Kindly recommend some funds and how I should allocate my money. I'm 40 years old and I'm a salaried professional. So I don't think he has any mutual funds right now with him, Sunil. His son's education is almost 18 years from now, so he's got a good amount of time with him. What would you recommend him? He's got a very stated goal. So what would you recommend, Sunil? How should he start off?
There are schemes which invest in both domestic as well as international stocks also. A combination of both will definitely help him because it's not only geographical diversification, it will be a dollar diversification or a currency diversification also. And on a long-term basis, we know that rupee depreciates against dollars. Right now, of course, dollar is getting beaten down for different reasons altogether. So that be the case, and because of his son's education, maybe he wants to study wants him to study abroad. A combination of schemes which will be investing in these two kind of geographies will definitely make sense for him to do a SIP in.
All right. Well, yes, it's in all probability going to be a foreign education, and we don't know what's going to be the whole currency situation, the whole inflation situation 18 years from now. Okay, well, we have... Keeping it with inflation, in fact, coincidentally, we have Subramaniam Pichai, who's saying as inflation is going up and stays around 7%, in India, of course, inflation, that CPI number has always been at that persistent 6-7%. How is the one who's going to retire in 1 or 2 years to do allocation of corpus of 1 crore rupees among debt for regular monthly income of 25,000 rupees and rest of the money in which mutual funds so that they can get return through SWP after 10 years so that there can be another stream of regular income for another 30 years. Oh, okay, very interesting question, Sunil, somewhat related to the whole exit strategy as well that we've been talking about. But yes, it starts off first with properly allocating that 1 crore rupees so that it can sustain for the next 30 odd years. What do you recommend, Sunil?
If he wants to, simplify his life, and I don't know, I'm assuming that he's a retired person or going to retire or whatever. The simplest solution for a 1 crore portfolio like this, if you are only requiring 25,000 rupees per month, is 10% should go into your emergency kitty, which can go into a liquid fund, fixed deposits, wherever he prefers. The 90 lakh rupees balance can actually be divided into 2 balance advantage fund category and do SWP. And that 25,000 per month on a 90 lakh rupees will only come to about 3.3 or 3.5% per annum kind of a withdrawal. And naturally, because the underlying securities would be growing at, say, 8 to 10% or even higher, since it's a balance advantage fund category, you will create wealth beyond that SWP also. So your 90 lakhs, you will be withdrawing that 25,000 per month. On top of that, your 90 lakhs is capable of growing over a longer period of time by creating an SWP stroke wealth creation strategy like this. And if he doesn't need the money immediately, then maybe that the balance advantage fund category can continue to grow on a growth side rather than doing any SWP. And at some point in time, whenever he wants to withdraw, instead of 3.5%, he can actually withdraw a higher amount also because there will be a cushion inbuilt in his portfolio.
All right, Mr. Pichai, I hope you've heard out, the recommendation from Sunil. If you have any follow-ups, please feel free to email us. Okay, Nagaraj writes, I'm salaried and 34 years old, and he wants to know, Sunil, what your opinion is on investing in US markets. He writes that I have my SIP going on in 4 mutual funds since 2017. I don't have any debt funds, However, I have heard of many ways in which US investing has become easier, and that it certainly has. Now you have direct platforms that help you invest in individual stocks as well, like a Facebook, Tesla, so on and so forth. And then, of course, the more old method of investing in US funds. Many mutual fund houses, Motilal, Axis, all of them have these US funds, Franklin, so on and so forth. So now he's asking you, Sunil, do you recommend it for retail investors like me? What's your view, Sunil, on US investing and foreign investing?
Absolutely. As I have just mentioned for the earlier question also, it's not only geographical diversification, it's a currency diversification also. I'm not talking about the timing the market, whether this is the best time to invest in US markets or not. All I'm saying is, yes, adding US or global equity portfolio, and I would definitely recommend through the mutual fund route rather than buying equities directly, which he may or may not be able to manage or monitor on a regular basis.
There are many mutual fund houses in India that invest in US or foreign markets, thus giving you the exposure that you would like. It may not be, Sunil does not recommend really sitting and nitpicking individual stocks. Yes, if you look at a Tesla and you look at the way it has rallied from, I think, $300 to $700, it definitely looks very mouth-watering. In fact, Mr. Elon Musk may just now dethrone Jeff Bezos as well and become the richest man in the world. But it's always easier to look at it in hindsight, as is the case even with Indian equity markets. So Sunil does advise that, especially since, we don't know much about foreign markets as well as we do know about the Indian markets, it's advisable that retail investors look at foreign funds, which are available in plenty now in the, from Indian mutual fund houses as well. All right. Well, on that note, we are completely out of time. So, Sunil, thank you so much for joining us today on ET Now. And, of course, wish you, your team as well, a very happy 2021.
All the viewers and to you also, Mubina. Thank you for having me on the show.
Well, folks, if you'd like to catch this episode once again, it will be put up on ET Now's YouTube channel under the Money Show playlist. So ensure you log in just an hour from now. And of course, don't forget our email address, themoneyshow@etnow.tv, is always welcoming your questions and queries. We're constantly monitoring it. So send them in to us and we'll get them answered. For now, we'll take a very short break on the show. Don't go anywhere.